The chart moved first. Then the volume arrived. No headlines yet, no explanation anywhere. But someone clearly knew. I remember watching the XRP chart that night. At first, it looked like another quiet trading session, the kind where prices drift sideways and traders slowly lose interest. Nothing unusual, nothing urgent. But then something changed. A single green candle appeared, not large enough to trigger alarms, not dramatic enough to trend on social media, but the behavior around it felt different. Liquidity started thinning. Orders sitting on the sell side of the book began disappearing, not all at once, just quietly fading away as buy pressure crept into the market. Then the volume started rising. Not explosive retail volume, not emotional panic buying. This was steady, controlled, deliberate. The kind of volume that usually comes from desks managing serious capital. And that's when the timeline stopped making sense, because the news hadn't happened yet. No new court ruling in the SEC case, no institutional partnership announcement, no major macro event. Yet XRP was suddenly behaving like something important had already been decided behind closed doors. Within the next hour, the price accelerated. Social media began waking up. Traders started asking the usual questions. Why is XRP moving? But the more interesting question was different. Why had the buying started before anyone knew why? That's when I started looking deeper into the blockchain. And what I found there changed the story entirely. A handful of wallets had been accumulating XRP hours earlier, quietly, patiently. One wallet stood out above the rest, because before it began buying XRP, it did something almost unthinkable in professional investing. It sold everything else first. Bitcoin, Ethereum, several long-term holdings that had been untouched for years, all liquidated, and the proceeds moved into a single asset, XRP, which raised an uncomfortable question. Why would someone make a bet like that before the market moved? But when I traced those transactions further back, the real story started to appear. The shift began just after midnight in New York. Most traders were asleep. Market activity was quiet. XRP had been drifting sideways for days, locked inside a narrow trading range that seemed to frustrate both bulls and bears. Nothing about the chart suggested something major was coming. Then the first signal appeared. A cluster of buy orders swept through the order book. Not enough to cause a breakout, but enough to remove several layers of liquidity sitting above the price. The effect was subtle, but experienced traders notice these details immediately, because when liquidity disappears, markets behave differently. Prices move faster, volatility increases, and small imbalances suddenly matter. Over the next 30 minutes, XRP began climbing slowly, just a few cents at first. But the pattern felt deliberate. Every dip was absorbed almost instantly. Every sell order that appeared was quietly matched by patient buyers waiting underneath. Meanwhile, the volume bars on the chart began growing, not explosive, but persistent. That distinction matters. Retail speculation usually arrives suddenly, emotional, chaotic, loud. Institutional positioning tends to look different. Quiet accumulation, repeated entries, steady pressure. And the more the chart developed, the more it looked like someone was carefully building a position without attracting attention. Then another signal appeared. Large transactions started leaving exchanges, millions of XRP moving into private wallets, not traders exiting, but holders securing assets, which suggested something bigger than a short-term trade might be unfolding. The market hadn't broken out yet, but the structure had already changed, and once that happens, the next phase often arrives quickly. When analysts later examined the blockchain data, one wallet immediately stood out. Not because it was famous, but because it had been invisible. The address had existed for years, quietly interacting with the network without drawing attention. Occasional transfers, long periods of inactivity, nothing remarkable. Until the week before the breakout, that's when the behavior changed. The first unusual transaction was a large Bitcoin transfer, then another, then a series of Ethereum sales. Within hours, the wallet had liquidated a portfolio worth millions. That alone was unusual. Professional investors rarely abandon diversified portfolios overnight. But the real surprise came next. The proceeds weren't parked in stablecoins. They weren't moved into traditional hedges. Instead, the funds passed through several intermediary addresses. Then they converged, all into XRP, transaction after transaction, systematic, disciplined, relentless. By the time the sequence finished, the wallet had converted nearly its entire crypto portfolio into XRP, a single concentrated position, the kind of move that requires extraordinary conviction. And when analysts compared timestamps with market activity, the purchases aligned almost perfectly with the quiet accumulation phase in the order books, which meant something important. While most investors were ignoring XRP, someone had been quietly building one of the largest new positions on the network, hours before the market noticed. To understand what happened next, you have to understand the mood surrounding XRP before the move. For months, the asset had been trapped in uncertainty. Every rally faded, every breakout attempt stalled, and the regulatory battle involving Ripple and the SEC hung over the market like a storm cloud. Investors hate uncertainty, especially long-term investors. Many retail holders had owned XRP for years, waiting for clarity that never seemed to arrive. Eventually, frustration replaced patience. Blockchain data showed a steady pattern, coins moving from cold wallets back onto exchanges. That usually means one thing: investors preparing to sell. The psychology was predictable. Bitcoin was outperforming. Ethereum had momentum. Newer projects were capturing attention. XRP looked stagnant. So retail investors did what markets often push them to do. They rotated out. Small holders sold during sideways trading, convinced their capital could perform better elsewhere. Ironically, that behavior created exactly the opportunity large investors wait for, because when retail investors sell out of frustration, liquidity appears, and patient buyers can accumulate positions without pushing the price higher, which is exactly what seemed to be happening beneath the surface. Retail investors believed they were exiting a stagnant market, but the blockchain suggested something else entirely. They might have been selling directly into quiet accumulation. The regulatory backdrop surrounding XRP has always been complicated. For years, the lawsuit between Ripple and the SEC cast uncertainty over the entire asset. Institutional investors dislike legal ambiguity, so many simply stayed away. But regulatory cases evolve slowly, and sometimes the most important developments are buried inside routine legal filings that few people read. One such filing appeared just days before the market began moving. At first glance, it looked technical. Procedural language, legal arguments, nothing dramatic. But analysts who study regulatory frameworks noticed something subtle. The tone had shifted. Certain arguments about the classification of digital assets were being interpreted differently. Not a final decision, not a headline, but enough to suggest that the long-term regulatory outlook might be improving. For institutional desks, those details matter enormously, because legal clarity determines whether large pools of capital can enter a market. And when traders later compared the timeline, the sequence became interesting. Accumulation began. Then the legal interpretation started circulating quietly among analysts. Then the market moved, which suggests something important about financial markets. Sometimes the earliest signals are not price movements. They're small changes in information flow. Institutional investors rarely move loudly. Unlike retail traders chasing momentum, large funds often accumulate positions long before the broader market notices. Their footprints tend to appear in subtle places: derivative markets, custody transfers, liquidity patterns, and in XRP's case, several of those signals began appearing simultaneously. First came the futures markets. Open interest in XRP derivatives began climbing steadily, while the spot price remained relatively stable. That combination is unusual. It suggests traders are building positions ahead of expected volatility. Then came custody movements. Large transfers of XRP began flowing between institutional custody providers and long-term storage wallets. That behavior typically signals accumulation by funds rather than short-term traders. Meanwhile, trading desks began reporting an increase in block-size transactions moving through certain exchanges. Again, not explosive activity, but consistent, disciplined, the type of buying that rarely appears on public headlines. Taken together, these signals painted a quiet picture. Institutional investors might have been slowly returning to the XRP market, not because of hype, but because the long-term regulatory and structural outlook appeared to be shifting. And if that interpretation was correct, then the quiet accumulation phase might have only been the beginning. Volume often reveals the truth long before price does. During the days leading up to the breakout, XRP trading activity displayed a classic accumulation pattern. Daily trading volume increased, but the price barely moved. To inexperienced traders, that looks like a stagnant market. But professionals see something different, a tug of war, large buyers absorbing supply while keeping the price stable. Every time sellers pushed the price slightly lower, a wall of demand appeared beneath it. The market would stabilize, then drift sideways again. This repeated dozens of times across multiple exchanges. Eventually, a pattern emerged. Sell pressure was being absorbed faster than new supply could appear, and when that happens, markets reach a tipping point, because once available supply dries up, even modest buying can trigger rapid price movement. That's exactly what happened. The moment sellers ran out, XRP broke out of its range. Volumes surged, and suddenly the quiet accumulation phase that had lasted days became visible to everyone. But by then, the positioning had already been done. Financial narratives change quickly. Before the breakout, XRP was widely viewed as an asset stuck in regulatory limbo. Analysts focused on legal risk. Commentators questioned whether institutions would ever return. Then the price moved, and the narrative began shifting almost overnight. Media outlets started revisiting the regulatory story. Research desks began publishing new outlooks on digital asset frameworks. Market commentators suddenly described XRP as undervalued, but by the time those headlines appeared, something important had already happened. The accumulation phase was over. Large positions had already been established. Retail investors were only just beginning to notice the move. This sequence repeats constantly in financial markets. Information spreads slowly. Positioning happens early. Public narratives arrive last, which explains why the biggest price movements often feel sudden to most investors. In reality, they've been developing quietly for days or weeks.